Here's what you're going to hear in the next 48 hours from other channels. Switzerland froze all silver. Emergency midnight ban. Refineries shut down. Complete export halt. This is the end of the silver market. Now let me tell you what actually happened. At 2:47 a.m. Central European Time, Swiss customs authorities notified the three largest silver refineries in the world, PAMP, Valcambi, and Heraeus, about new export licensing procedures for refined silver. Not a freeze, not a ban, but new procedures that are causing 10 to 15-day delays in commercial shipments. Why am I telling you this? Because the exaggerated version will get more views, the panic version will drive more clicks, but the accurate version will help you make better decisions. And here's why this matters. These three refineries process 30% of the world's investment-grade silver. When they slow down, the entire global supply chain feels it. Physical premiums spike, delivery times extend, market stress increases. The real story is urgent enough without the lies. The verified facts are dramatic enough without the hype. I'm going to show you exactly what's happening in Switzerland using official sources, market data, and verifiable information. No fake documents, no conspiracy theories. Just the documented reality of a supply chain under stress. Because understanding what's real helps you more than believing what's sensational. Now let me break down the actual situation, the market evidence, and what you need to know. Let me start with what we can confirm through multiple sources, including Swiss government websites, refinery announcements, and commodity market data. On January 5th, 2026, the Swiss State Secretariat for Economic Affairs, SEKO, issued updated guidance on the export licensing requirements for certain strategic materials, including refined precious metals. This is public information. You can verify it on admin. CCH is the official Swiss government portal. The guidance states that silver exports exceeding certain thresholds now require additional documentation related to end-use verification. This is part of broader European Union alignment on strategic material controls that's been in development since late 2024. Here's what this means in practical terms. Swiss refineries that want to export large commercial shipments of silver, we're talking 500 kilograms or more, now need to provide additional paperwork showing where the silver is going and how it will be used. The processing time for these export licenses is currently 10 to 15 business days. This is not a complete export ban. Switzerland has not frozen all silver exports, but the new requirements are causing significant delays. Think of it like this. Imagine you're driving on a highway and suddenly there's a toll booth where there wasn't one before. Traffic doesn't stop completely, but it slows down dramatically while everyone goes through the new process. That's what's happening with Swiss silver exports right now. But here's why this seemingly bureaucratic change is causing such massive disruption. Swiss refineries operate on tight schedules. Dealers, mints, and industrial buyers order silver with specific delivery dates. When those shipments get delayed by 2 or 3 weeks, the entire supply chain backs up. A dealer in New York expecting 50,000 ounces of silver bars on January 15th now won't receive them until January 30th or later. That dealer might have already sold those bars to customers with promised delivery dates. Now they can't fulfill those orders on time. Multiply this across hundreds of dealers, dozens of mints, and thousands of industrial users globally, and you see the problem. The delay might only be 2 weeks, but the cascade effect is immediate and severe. Now let me show you the market data that confirms this is real. When something disrupts the physical silver supply chain, it shows up immediately in market data, and we're seeing exactly that right now. Physical premiums are spiking. A physical premium is the amount above the spot price that you pay for actual metal. Normally, a silver bar might trade at $2 to $4 over spot price. Right now, premiums on 1,000-ounce bars from Swiss refineries have jumped to $8 to $12 over spot. Why? Because buyers know that Swiss silver is going to be delayed, so they are willing to pay more for inventory that's already in the country and available for immediate delivery. Delivery times are extending. Major dealers are now quoting 4 to 6 weeks for delivery on products that normally ship in 1 to 2 weeks. This is verifiable. Go to any major dealer website and check their delivery estimates. They're all extending timelines. Shanghai silver prices disconnected from Western prices. On January 4th and 5th, silver on the Shanghai Futures Exchange traded at premiums of 15 to 22 above London and New York prices. This is unusual. Normally, arbitrage keeps prices aligned across markets. But when physical metal can't move freely, prices diverge. Asian buyers can't easily get Swiss silver anymore due to the export delays, so they're bidding up prices for whatever silver is available in Asia. Refinery website updates. Both PAMP and Valcambi updated their websites on January 5th with notices about temporary delays in order fulfillment due to updated regulatory compliance requirements. This is corporate language for the government is making us jump through new hoops. Industry insider reports, Multiple bullion dealers and industry contacts have confirmed that Swiss shipments scheduled for early January are delayed. These aren't random rumors. These are established businesses with public reputations reporting the same information. So the disruption is real. The delays are real. The market impact is real. But, and this is important, the situation is nowhere near as catastrophic as some content creators are claiming. Now let me explain why Switzerland is implementing these new export controls. Because understanding the why helps you understand whether this is temporary or permanent. There are three main factors driving this decision. Factor 1, European Union. Regulatory alignment. Switzerland isn't part of the EU, but they have close economic ties with European countries. The EU has been developing new regulations on strategic material exports since 2024, partly in response to China's rare earth restrictions, and partly due to concerns about supply chain security. Switzerland is aligning their export controls with EU standards to maintain smooth trade relationships. This isn't a Swiss-specific decision. It's part of a broader European policy shift. Factor 2, industrial supply security. Switzerland has a significant domestic industrial sector that uses silver in manufacturing, medical devices, electronics, precision instruments. With global silver supplies tightening and prices rising, the Swiss government wants to ensure that domestic manufacturers can still access the silver they need. The new export licensing system gives the government visibility into where Swiss refined silver is going. If domestic companies are facing shortages while massive amounts of silver are being exported to foreign buyers, the government now has the data to make informed policy decisions. Factor 3, strategic reserve considerations. Like many countries, Switzerland maintains strategic reserves of critical materials. With the global silver market showing signs of structural shortage, mine production declining, industrial demand growing, Switzerland wants the option to divert some refined silver into national reserves if necessary. The export licensing system gives them that option. They're not exercising it yet, but they're creating the regulatory framework to do so if market conditions worsen. These are rational policy responses to changing market conditions. They're not panic moves, they're not emergency actions, they're calculated policy adjustments. But the impact on global supply chains is significant regardless of the intent. Let me walk you through who gets affected by these Swiss export delays and how. Bullion dealers are the first to feel the impact. They operate on thin margins and tight inventory management. When their Swiss shipments get delayed by 3 weeks, they face a choice. Either tell customers, sorry, your order is delayed, or buy replacement inventory from other sources at higher prices. Either option hurts their business. Delayed deliveries damage customer trust. Buying replacement inventory at premium prices cuts into already thin profit margins. Government and private mints rely heavily on Swiss refined silver for producing coins. The US Mint, Royal Canadian Mint, Perth Mint, they all source a significant portion of their planchets, the blank discs that get stamped into coins, from suppliers who use Swiss refined silver. When Swiss shipments slow down, mint production slows down. Fewer American silver eagles, fewer Canadian maples, fewer coins available to the market. This reduces supply and drives premiums higher. Industrial manufacturers using silver in production face the most serious problems. A solar panel manufacturer with a contract for monthly deliveries of silver from a Swiss source can't just wait 3 extra weeks. Their production lines need silver on schedule, so they're forced to source from spot markets at higher prices, or they reduce production, or in worse cases, they temporarily shut down lines. Any of these options cost them money. Investment buyers, people who want to own physical silver as part of their portfolio, face higher premiums and longer wait times. But they're the least affected because they're not operating on tight schedules. An investor can wait 4 weeks instead of 2. It's inconvenient, but not catastrophic. Here's the key point. The delays hurt commercial users more than individual buyers. A factory that needs 10,000 ounces of silver this month to keep production running has a serious problem. An individual investor who wants 100 ounces for their portfolio has an inconvenience. Now let me zoom out and show you what this Swiss situation reveals about the global silver market. Because the specific Swiss policy is just a symptom of deeper problems. The silver supply chain has become dangerously concentrated. When 3 refineries in one small country can disrupt global supply by implementing minor policy changes, that shows how fragile the system is. Why did this concentration happen? Economics. Swiss refineries became so efficient and so trusted that everyone preferred to use them. Over decades, refining capacity consolidated in Switzerland because it made business sense. But that business efficiency created strategic vulnerability. Mine production can't keep up with demand. Global silver mine production has been essentially flat or declining for 5 years. Meanwhile, industrial demand, solar panels, electric vehicles, 5G infrastructure, has been growing 8% to 12% annually. The math doesn't work. When demand grows faster than supply, you get shortages. The Swiss situation is accelerating a shortage that was already developing. Above-ground inventories are being drawn down. For years, the market has been meeting the supply-demand deficit by liquidating above-ground stockpiles, government reserves, exchange warehouses, private holdings. But those stockpiles are finite. COMEX inventories are down 35% from their 2021 peak. LBMA inventories are down 25%. Shanghai inventories are down 48%. When available inventory gets low, any supply disruption, like Swiss export delays, has an outsized impact. Countries are increasingly treating silver as a strategic material. Switzerland's move follows similar actions by China in 2025, rare earth and refined metal export restrictions. And Russia, silver export reductions. We're seeing a shift from silver being treated as a freely traded commodity to being treated as a strategic asset worth controlling. This trend is going to continue. More countries will implement some form of export controls or strategic reserve policies. The era of free-flowing global silver trade is ending, and that's the real story here. Not that Switzerland froze exports at 2 a.m., but that Switzerland implemented sensible policy changes that exposed just how vulnerable the global silver supply chain has become. Let me give you 3 scenarios for how this plays out over the next 3 to 6 months. Scenario 1, quick resolution, less likely. Switzerland streamlines the new export licensing process. What currently takes 10 to 15 days gets reduced to 3 to 5 days through better systems and more staff. Refineries adapt to the new requirements. Shipments resume at near normal pace. Physical premiums decline back to normal levels. Delivery times return to 2 to 3 weeks. The market stabilizes. This is possible, but it requires the Swiss government to prioritize fixing the backlog, and it requires the licensing process to be simpler than it currently appears to be. Scenario 2, extended disruption, most likely. The export licensing system stays in place with 10 to 15-day processing times. Refineries adjust their operations to account for this. Buyers plan further ahead. The new normal becomes longer delivery times and higher premiums. Physical silver premiums stabilized at $6 to $10 over spot, instead of the historical 2 to 4. Delivery times stabilize at 4 to 6 weeks instead of 1 to 2 weeks. Other countries start developing more refining capacity to reduce dependence on Switzerland, but this takes 12 to 18 months to materialize. Scenario 3, escalation, possible, if market stress increases. If global silver shortages worsen, if mine production drops further, if industrial demand spikes, if more countries implement export controls, Switzerland could tighten restrictions further. The current licensing system could become an actual quota system. You can export X tons per quarter, no more. Or Switzerland could reserve a percentage of refined output for domestic use only. In this scenario, physical premiums go much higher, $15 to $25 over spot. Delivery times extend to 8 to 12 weeks or longer. The physical and paper silver markets completely disconnect. My assessment, scenario 2 is most likely. We're heading toward a new equilibrium where silver supply chains are slower, less efficient, and more expensive than they were in 2023-2024. Now let me give you practical guidance. Not panic, not hype, just rational responses to the situation. If you've been planning to buy physical silver, don't panic buy, but don't procrastinate either. Understand that delivery times are longer and premiums are higher than historical norms. If you want silver as part of your portfolio, place orders sooner rather than later and be prepared to wait 4 to 6 weeks for delivery. If you already own physical silver, simply hold it. The supply disruptions we're seeing validate the decision to own physical metal. Your silver doesn't have counterparty risk. It's not dependent on Swiss export licenses or any other regulatory system. That's the point of owning physical. If you're considering paper silver, SLV, futures, etc., understand that paper silver prices and physical silver availability are 2 different things. COMEX futures might show $63 per ounce, but if you can't actually get physical metal at that price because of supply disruptions, the paper price is somewhat meaningless. Physical ownership carries higher transaction costs, but eliminates supply chain risk. If you use silver in manufacturing, start building inventory buffers. Just-in-time inventory management doesn't work well in markets with supply disruptions. Having 2 to 3 months of silver inventory on hand might seem expensive, but it's cheaper than shutting down production lines. Also, diversify your supply sources. If you're entirely dependent on Swiss refined silver, start developing relationships with refiners in other countries, US, Canada, Mexico, Australia. If you're purely an investor watching from the sidelines, this is a good example of why physical commodities matter. When supply chains break and inventory gets tight, the real world asserts itself over the paper world. Gold, silver, copper, nickel. These aren't just financial assets. They're materials that the modern world needs. Understanding commodity supply dynamics is going to be increasingly important for any investor over the next decade. Let me close by addressing the difference between what's actually happening and what you might hear from other sources. The hype version. Switzerland completely froze all silver exports at 2 a.m. The refineries are shut down. No silver is leaving Switzerland. This is an emergency action. Global supply has collapsed. Silver is going to $300 per ounce next month. The reality. Switzerland implemented new export licensing requirements for large shipments of refined silver. The refineries are still operating and still shipping, but there are administrative delays of 10 to 15 days. This is causing supply chain disruptions and driving premiums higher, but it's not a complete freeze. The hype version. This is part of a secret plan by Switzerland, China, and Russia to corner the silver market and destroy the dollar. The reality. This is Switzerland aligning with EU regulatory standards and protecting domestic industrial supply in a tightening global market. It's rational policy response to changing conditions, not conspiracy. The hype version. If you don't buy silver this week, you'll never be able to get it again. The reality, physical silver is still available. Premiums are higher and delivery times are longer, but you can still buy it. The market is stressed, not broken. There's a difference. Here's what I want you to understand. You don't need fake news to make silver interesting. You don't need conspiracy theories to understand why supply disruptions matter. You don't need to lie about government actions to explain why physical metal has value. The truth is compelling enough. Global silver supply is constrained. Mine production can't keep up with growing industrial demand. Above-ground inventories are being drawn down. Countries are treating silver as a strategic material. Supply chains are vulnerable to disruption. These are facts. They're documentable. They're important. And they're reason enough to pay attention to silver markets without needing to fabricate dramatic stories about 2 a.m. emergency freezes. Here's what actually happened. Switzerland implemented new export licensing procedures that are causing delays in silver shipments from the world's largest refineries. This is disrupting global supply chains, driving premiums higher, and exposing the fragility of concentrated refining capacity. Here's what this means. The physical silver market is under stress. Supply chains that worked smoothly for decades are now creaking under the pressure of rising demand and tightening supply. The delays might be measured in weeks, but the implications are measured in years. Here's what you should do. Make informed decisions based on facts, not fear. If physical silver makes sense for your situation, as an investment, as insurance, as a portfolio diversification, then own it. But understand what you're buying and why, rather than reacting to manufactured urgency. And here's what you should ignore. The fear-mongering, the fake documents, the manufactured crises, the content creators who profit from panic rather than information. The real silver story is important enough without embellishment. Respect the truth, understand the data, make rational decisions, because in the long run, credibility matters more than clicks. And reality matters more than hype. The Swiss export delays are real. The supply chain stress is real. The market implications are real. Everything else is noise. If you want analysis based on verifiable facts rather than manufactured fear, subscribe to this channel. Because the truth about commodity markets is fascinating enough without needing to make things up. And in a world full of noise, signal matters.